This is the last chapter of the reference guide to regulatory compliance. It's titled Securities Related Activities of Banks. It has a little subtitles here. The retail sales of non-deposit investment products interagency statement and the exception for banks from the definition of broker in Securities Exchange Act. Familiar with both of these, but we're combining them and calling this whole thing Regulation R. In the early 1990s, the banking industry in the United States was marked by the rapid growth in popularity of non-deposit investment products. Before this time, these uninsured investment products had been marketed primarily by non-bank financial institutions to fairly sophisticated customers. However, the competition for deposits became more fierce with the drop in deposit interest rates during the early and middle 1990s, and these non-deposit investments began to appeal to a wider constituency, particularly to middle-income consumers. As bank sales of these investments became more popular, banking regulatory agencies became concerned that retail customers could be confused as to the nature of the investments compared to traditional deposit accounts. Because deposit accounts have FDIC insurance, the insurers believed consumers would mistakenly assume non-deposit investments were also insured by a governmental agency. Therefore, in February of 1994, the 4 federal banking and thrift agencies issued an interagency statement establishing guidelines on retail sales of mutual funds and other non-deposit investment products by insured financial institutions. The interagency statement on retail sales of non-deposit investments. This statement set forth advertising and disclosure requirements as well as requirements for sales personnel involved in marketing of these products. While the statement is not as detailed as an official regulation, the failure of an institution to abide by the guidelines could subject it to corrective action by the appropriate agency. In November of 1999, the Gramm-Leach-Bliley Financial Modernization Act, GLBI, was enacted, eliminating the existing bank blanket exemption from registration as a broker under the Securities Exchange Act of 1934 and replacing it with statutory exceptions for certain specified securities activities that have traditionally performed in banks. Bank activities that could not satisfy the requirements of the exceptions would have to be pushed out of the bank and into a broker regulated by the Securities and Exchange Commission. The loss of the exemption was to be effective upon adoption of rules implementing the push-out provisions. In 2001-2004, the SEC engaged in 2 separate proposed rulemakings to implement the broker push-out provisions of GLBI. Both proposals were roundly criticized by both the industry and bank regulators. In September 2006, Congress passed the Financial Services Regulatory Relief Act, which voided the SEC's previous rulemakings and required the SEC and the Federal Reserve Board jointly to promulgate entirely new rules to implement the broker exception. The joint proposal was released in December 2006, and the final rule was adopted in 2008. Regulation R fleshes out the requirements of statutory exceptions of GLBI for securities activities in which banks may continue to engage without registration as a broker. In addition, the regulation provides additional exemptions for banks' securities-related activities. Among the activities covered by Regulation R are trust and fiduciary activities, custodial activities, sales of and sweeps related to money market mutual funds, securities lending and payment of compensation to bank employees who are not registered with the SEC for referrals of securities business to brokers. Regulation R applies both to retail and institutional private banking securities activities. Retail sales of non-deposit investment products in interagency statement. Part 1 coverage, all financial institutions with federally insured deposits and covered activity 1 through 4, retail sales by banks of non-deposit investment products such as mutual funds and annuities to consumers. 2, retail sales by third parties, not bank employees, occurring on the premises of the bank. 3rd, referrals of bank customers to a third-party broker in the bank if the bank receives a referral fee. And 4th, the statement does not apply to separate affiliated entities of consumer non-member banks that are otherwise regulated for the sale of non-deposit investment products and that do not operate on the premises of the bank, or non-retail customers such as sales to fiduciary accounts. Requirements under the interagency statement include disclosures, management requirements, and getting into the general disclosure requirements. Banks should ensure that retail non-deposit investment customers are fully informed as to the nature and risks associated with the investment. 2. Minimum disclosure requirements. Customers should be fully informed that the investments are not insured by the FDIC and are not deposits or obligations of the institution and are not guaranteed by the bank. And lastly, are subject to investment risk, including the loss of principal. 3rd, under disclosures, they should be clear and conspicuous and easy to comprehend. The timing of the disclosures should be provided at the following times: A, B, C, or D. A, orally during the sales presentation. B, orally when investment advice concerning non-deposit products is given. C, orally and in writing before the opening of an investment account. And D, in all advertisements. 5th, disclosures should be acknowledged by customers in writing with a statement that the customer understands the disclosures. 6th, disclosures should be made in addition to any other confirmation disclosure required by law. Advertising rules 1 through 5. 1. Should conspicuously include minimum disclosures and cannot suggest or convey any inaccurate, or misleading impressions about the nature of the investment or its lack of FDIC insurance. 2. Should include minimum disclosures in telemarketing. 3. Advertisements should clearly identify the company selling the investment product. 4. If information about both deposits and non-deposit investments are included in the same material, the information should be clearly segregated to avoid confusion. 4. Exemptions 1, 2, and 3. Radio ads of 30 seconds or less. Electronic signs and banners or signs indicating location only. And 5th, abbreviated disclosure containing the phrase "not FDIC insured, no bank guarantee, may lose value" is permitted. Other disclosures under the general requirements 1 through 5. 1. If applicable, the bank should disclose any advisory or other relationship between the bank or an affiliate of the bank and the investment company whose shares are sold by the bank. B. Any relationship between the bank and an affiliate involved in providing non-deposit investment products should be disclosed. 3. Any fees, penalties, or surrender charges should be disclosed. D. All disclosures should be made at the time of or before an account is open. 5. The bank should provide clear and accurate written or oral explanations of coverage other than FDIC insurance, such as may be provided by the Securities Investor Protection Corporation, SIPC, a state insurance fund, or private insurance to minimize confusion with FDIC insurance. Product identification number 6. A non-deposit investment product must not have a name that is identical to the name of a depository institution. And second, a non-deposit investment product with similar names to retail banking products should be designated and presented in a sales program in a way that minimizes the risk of confusion to the customer. B. Management requirements. 1. The program statement. 2. The policies and procedures, and these are just requirements under the interagency statement within management requirements. There's the program statement, policies and procedures, third-party arrangements, requirements for the setting and circumstances of the sale of non-deposit investment products, qualifications and training of personnel who sell non-deposit investment products, suitability requirements, compensation, and the compliance program. To get into the program statement more specifically, the bank should adopt a statement that 1 through 5. 1. Outlines the features of the bank's investment program. 2. Addresses the risks associated with the investment program. 3. Contains a summary of the policies and procedures that make up the management system. 4. Addresses the scope of activities of any third party involved. And 5. Sets forth the procedures for monitoring compliance by third parties. Policies and procedures the bank should adopt include 1. Ensure compliance with all applicable laws and regulations. 2. Provide for senior managers to exercise supervisory authority for each activity of the program. 3. Detail the criteria governing the selection and review of each type of product that is sold or recommended. 4. Outlining the procedures for the use of information about the bank customers. 5th, designate the employees who will sell the investment products. 6, list responsibilities of employees who sell investment products. 7, describe appropriate referral activities. And 8, establish training requirements and compensation for each class of personnel. Third-party arrangements. If a third party is involved in sales of investments, the bank should have a written agreement with a third party that describes the duties and responsibilities of each party, specifies that the third party will comply with all applicable laws and regulations, including the interagency statement. C, authorizes the bank to monitor the third party to verify compliance with the agreement. 4, authorizes the bank to have access to the records of the third party as necessary. 5, requires the third party to indemnify the bank for potential liability resulting from the actions of the third party regarding the sales program. And 6, provides for written employment contracts for personnel who are employed both by the bank and the third party. 4th, requirements for setting and circumstances of the sale of non-deposit requirement products. 1 through 4. 1. Sales of non-deposit products on the premises of a bank should be conducted in physical locations separate from the retail deposit area. 2. If the area cannot be separate, the bank must take steps to ensure that customers are not confused between the non-deposit investments and insured deposits. And 3. Tellers and other employees involved in accepting insured deposits may not sell non-deposit investments, accept unsolicited orders for them, or recommend them to a customer. And D, tellers and other employees involved in accepting insurance deposits may refer customers to the personnel who are trained to sell non-deposit products. Qualifications and training of personnel who sell non-deposit investment products under the management requirements of the interagency statement is 1 through 5. 1. All personnel who sell non-deposit investment products and give investment advice must be trained on the specific products being sold. 2. Training should be equivalent to that required for persons qualified to sell investment securities. 3. Training on the basics of the non-deposit investment products as well as on bank policies regarding these products should be provided to other bank employees who interact with customers. D, all training should be periodically updated. And 5th, if a potential employee has experience in the investment industry, a background check should be performed to determine if the person has been subject to disciplinary action by other regulatory agencies. Suitability requirements under management requirements under the interagency statement reads that persons who recommend non-deposit investment products to customers should have reasonable grounds for believing the product is suited to the needs of the customer based on information provided by the customer. Reasonable efforts must be made to obtain financial information that discloses the customer's tax status and investment objectives. Compensation is the second to last piece under management requirements under the interagency statement. A, B, and C. A, bank employees' referral fees. Bank employees may receive one-time nominal fixed-rate fees for referrals of a customer, and the fee cannot be based on whether or not the customer purchases the product. For sales personnel, while sales personnel may receive incentive compensation, it must be structured so it does not result in unsuitable sales made to customers. And lastly, audit and compliance personnel. Bank personnel involved in auditing and compliance may not receive incentive compensation related to the sales of non-deposit investments. Compliance program, the last management requirement under the interagency statement. A, B, C, and D. A, policies and procedures. B, auditing. C, customer complaints. D, conflicts of interest. For policies and procedures, banks should establish a compliance program including adequate policies and procedures to ensure that the bank's activities comply with the applicable laws and regulations. B, auditing, banks should establish a periodic review system to ensure that policies are followed. Reports should be made to the board of directors. Customer complaints, banks should provide for periodic review of customer complaints regarding the sales of non-deposit investments to ensure that the sales are being conducted in compliance with the bank's policies. And D, the bank's compliance program should identify conflicts of interest and specify how these conflicts will be handled. Lastly, in the penalties section, violations of the interagency statement are subject to censure and corrective action by the federal banking agencies.